In October 1931, Istvan Fekete, owner of one of Budapest's oldest jewellery shops, called his apprentice son Andras to the counter. It was Andras's 12th year in the trade. He had learned to polish silver, evaluate stones, and talk to customers. But that day his father taught him none of those things. He placed 2 boxes on the table. One held Hungarian pengo banknotes, a full year's savings. The other held small gold ingots. "Which one is the shop?" he asked. Andras looked at the banknotes, then at the gold. "Both," he said. Istvan nodded slowly. "No, one is the shop. The other is the shop's survival." Andras didn't fully understand the difference until 10 years later, when he watched the pengo collapse into nothing. This is where we need to stop. Because when you look at every major crisis since 1900 and trace what happened to $10,000, or its equivalent in savings at the time, what emerges is this. People have been asking the wrong question. They ask what grew the most? But the real question is, what still held value when the system itself broke down? Growth and survival are not the same thing. And throughout history, everyone who confused the two lost everything at the exact moment of that confusion. The 1906 San Francisco earthquake is almost always told as a natural disaster story. Its financial dimension is rarely discussed. Much of the city burned, banks closed, access to deposits was restricted for weeks. Some of the wealthiest merchants in the city were nearly wiped out within days. They held cash, and that cash either burned or became unreachable. Who survived? Those who held real property, gold and jewellery, and those who kept accounts outside San Francisco. Who didn't make it? Those who had tied everything to a single city's single system. This wasn't a market failure, it was a geographic concentration risk. But the lesson was identical. Where value is physically stored matters as much as the value itself. That idea of geographic concentration took on a completely different shape in 1950s China. When the early waves of private property confiscation swept through Mao's China, many of Shanghai's major businessmen lost everything. But a small group didn't just survive, they rebuilt in Hong Kong and Taiwan. What did they have in common? They had moved their value, physical jewellery, hard currency rather than paper receipts, and most critically, professional skills and trade relationships. A factory can be seized, but a merchant's decade-long network travels with him. Who survived? Those who had placed their value in human capital and portable assets. Who didn't? Those who had left everything physically anchored to Chinese soil. The survivors weren't lucky. They had simply known which part of their wealth was immune to political decision-making. That immunity was tested again during the 1973 oil crisis, but through an entirely different mechanism. The gasoline lines in America are well known. What's less discussed is this. Between 1973 and 1974, as inflation accelerated rapidly, equities lost roughly a third of their real value. $10,000 sitting in the S&P 500 eroded significantly in purchasing power within 2 years. That same money held in raw energy company shares or farmland didn't just survive, it appreciated. Who survived? Those who held assets that fed on inflation, things that rose in price as everything else became more expensive. Who didn't? Those waiting in fixed income instruments and broad index funds. The lesson sounds simple but gets skipped almost every time. Understanding which prices a crisis pushes upward is, by itself, enough to protect against it. The question of what a crisis pushes upward was tested in its most brutal form in 1990s Russia. As the Soviet system dissolved, the ruble collapsed, banks failed, and savings evaporated. Moscow's middle class lost most of what it had accumulated over decades, but a small group built extraordinary wealth in the same period. The first generation of oligarchs. What separated them wasn't just political connections. The critical difference was this. They acquired privatization vouchers from citizens who didn't understand what they represented, at a fraction of real value. Value didn't disappear. It was transferred from those who couldn't see it to those who could. Who survived? Those who understood which assets held genuine value when the system repriced everything. Who didn't? Those waiting for the state to protect the value of their currency. Russia delivers a harsh lesson. In a crisis, the true advantage comes not from knowing what others hold, but from knowing what actually carries value. Zimbabwe in the early 2000s lived the most extreme version of this lesson. As hyperinflation took hold, the Zimbabwean dollar lost its value within days. The little-known dimension here is this: agricultural land, despite the expropriation programs, retained its physical production value in the short term. Those who could hold on to land, or who had networks to convert harvests into foreign currency, survived. Who didn't make it? Those holding Zimbabwean dollars in bank accounts, because that money was nothing more than a number that a government printing decision had reduced to near zero. Who survived? Those who kept value tied to physical reality: land, crops, hard currency. Zimbabwe looks like an extreme case. But the mechanism isn't extreme at all. Every paper currency owes its value to an institution's promise. The weaker that promise gets, the more physical reality asserts its value. 6 different crises, 6 different geographies, 6 different decades, but a single mechanism running beneath all of them. When a system comes under stress, promise-based values, currency, bonds, deposits, paper securities, shake along with the institution behind the promise. When that shaking begins, people start questioning the real value of their paper holdings. But everyone does this at the same time, and when everyone searches for the exit simultaneously, demand for physical assets drives their prices upward, which means physical asset holders win twice, once by being protected from value loss, and again from the appreciation that surging demand creates. This isn't an investment strategy, it's a mechanism, and this mechanism works the same way every single time, because people give the same delayed response every single time. They hold paper while the system looks credible, and by the time they question it, they're already late. The first thing this produces is simple. $10,000 is only as secure as the guarantee of whatever holds it. And if that guarantee comes from an institution, a government, or a bank, the question isn't how solid that institution is right now, but how solid it will remain. Those two questions give very different answers. San Francisco's bank was solid in 1906. Hungary's banking system was solid in 1931. The Soviet state looked powerful in 1990. Solidity is a snapshot. Survival is a film. Within that film, the assets that consistently survive share one quality. They don't owe their value to someone else's next decision. A gold bar doesn't lose value because a central bank changes its interest rate. A piece of farmland doesn't go to zero because a bank fails. A trade network doesn't get erased by a currency reform. This quality is precisely what makes these assets superior in a crisis, and it is the exact opposite of what makes them boring when no crisis exists. Boring and durable are often the same thing. They just take different names in different eras. Psychologically, this is hard to see, because people trust most whatever has performed well recently. Technology in 1999, real estate in 2006, crypto assets in 2021. Past performance does not guarantee future results, is written everywhere and internalized nowhere, because the brain weights recent data far more heavily than distant history, and this weighting error delivers its most destructive result at the exact moment a crisis arrives. There is also institutional pressure. Banks sell deposits, brokers sell their own products. Financial media covers volatile, narratively compelling assets. Land, gold, skills, and networks have no narrative. They don't produce charts, don't make headlines, don't go viral. That silence doesn't mean these assets lack value. It means precisely the opposite. No narrative means no crowd, and no crowd means more predictable pricing when a crisis arrives. Looking at today's data, global central bank gold purchases between 2022 and 2024 reached their highest volume since 1967, documented in World Gold Council reports. Institutional investor interest in farmland and logistics infrastructure has grown measurably over the past 5 years. In the United States, the private credit market has doubled since 2020, indicating that a value transfer mechanism outside the traditional banking system is expanding. An institutional demand for long-term government bonds has relatively contracted, particularly among large pension funds. These movements are not independent of each other, but rather than saying what they mean, it seems more honest to leave the observation itself here. When Istvan Fekerte's son Andras looked at the 2 boxes on his father's table, he saw both as money, but one was an institution's promise. The other was a reality that needed no promise. 10 years later, on the day the penguin